Good morning. I'm Ross from Coonsmith Property Accountants, and I'm going to speak about the election. A couple of little things from it, little summary, and some great opportunities that have come out of it, or hopefully will come out of it. So I'm just going to share my screen and start off. So obviously this is general information, it's not specific advice. So if you're looking at doing a restructure, looking at something to do with your structure, get some specific advice, come and see me, have a proper appointment with me, and we can give advice for your situation. So this is just general information in this webinar. So first of all, it's really important to think, why did the changes happen? So why was Brightline introduced? And basically it was because IRD was struggling with the intention test. A whole lot of people were basically speculating on properties, buying properties, doing them up, selling them, not paying tax. So Brightline originally came in at 2 years to stop that happening or reduce it. 2 years wasn't enough, so it went to 5 years. And then to 10 years. So we might disagree exactly, but to me, 2 year Brightline, if it goes back to that, it's not going to solve that problem. So just be aware that it might be a short-term thing. Some government in the future is going to change it, reintroduce it, increase it to 5 or 10 years, or rearrange it. So if it does change to 2 years, it might not be changed for good, because it is actually being introduced for a reason. And that reason hasn't changed. It's still a lot of people, if it's 2 year Brightline, are going to buy a property, do it up, hang on just over the 2 years, sell it and not pay tax. And that potentially is not correct. Interest limitation and ring fencing. In the past, if we go back 10 or 15 years, we've got clients who were getting thousands of dollars of tax refunds every year. They were holding a property for 10 years, getting refunds every single year, never paying any tax. So what happened is ring fencing came in, basically stopping residential rental losses, offsetting personal income or business income or other income. Interest limitation sort of was brought in because even without the tax refunds, property investors could go 10 years, never ever pay a cent of tax, then sell and have a huge capital gain of $1 million, not pay any tax on that. So fundamentally, there is a slight problem there, and we can see that other governments will be targeting those at some point. So not expecting ring fencing to change, and interest limitation, it might disappear under National Act. But at some point, this is going to come up again, and something like interest limitation could come back in, or there could be wealth tax. But property investors don't pay a lot of tax generally, and a lot do hold property for 10 years without paying a cent of tax. So chances are that a future government is going to look at this again at some point. So don't think it's gone for good. So what that means, or what National's proposing for Brightline, and this comes from their back pocket boost information. They're proposing that it's going to be 2 years by July 24. And then they have a further comment which links into that July 24, and basically saying that property acquired before July 2022 will not be subject to Brightline at sale. That's once we get up to July 2024. So you've had a property that you've owned since July 2020. Under the 5 year Brightline, normally you'd have to wait until July 25 or longer before you sold that to be outside Brightline. These rules, if it was purchased before July 22, once you get to July 24, then it's going to be outside of Brightline. That is good news for people who are looking at changing around. Just be aware of two things. One, don't do an early sale and purchase agreement. Brightline goes off sale and purchase. So if you do a May 24 sale and purchase agreement to settle in August 24, that is going to be captured. And if you're within your Brightline, not into this new 2 year rule, you're going to be taxable. So don't do an early sale and purchase agreement. Second, Brightline is only one of the many ways that can be taxed. There's lots of other rules. One example is builders rules, but there is lots of other ways that you can be taxed. So be careful. Just because you're outside of Brightline doesn't mean you won't be taxed, and make sure you check the other taxing provisions. Interest limitation, current. Purchase 27th March 21 or after. If there's no exemption, it's not new build, it's not social, you're not getting one of the other exemptions, we are getting no deduction for interest from the 1st of October 21. So when we're doing 2023 tax returns, there would be no tax deduction. 24 year, which we're obviously in, from the 1st of April 23, there would be no deductions for interest. So the proposed rules coming through is we don't know. Big question marks. We don't know what exactly is going to happen with that. National haven't been that clear. My guess would be that we go to, for these properties, we go to 50% from the 1st of April 24. So the 23 year still zero, 24 year ending 31st of March 24, most likely still zero. And most likely the change is going to come from the 1st of April 24 and align with National's other changes, which we'll cover in a second. That is a big fat guess. National have not been clear. The legislation is out, so we don't really know. Big thing, Brightline or interest limitation, legislation is not finalised. So the 2-year Brightline has not happened. Interest limitation rules have not changed yet. So we obviously need National and ACT to actually win and get in government and form a government, and then we need to make them, for them to make the changes, actually legislation to come in. So this is all proposed at the moment. It is not fact. Current rules, purchase 26th of March 21 or before. These are the ones where interest was phased out. So if we had no exemption, not new build, not social, not one of the other exemptions, year ending 31st of March, we're down to 75% interest deductible. 2024, we're looking at 50%. 2025, looking at only 25% deductible, and 2026, 0% deductible. So that makes a big difference for property investors. So we've got a little example, and I'll also put the link to this. This is on one of our blogs. It's got a new build versus an existing. Say you've got rental income for this existing property, no exemption, 35,000. Expenses 13,000. You know, your rates, insurance, repairs. You're getting chattels depreciation done. We always love chattels depreciation. It's our number one tip. Easy way to reduce tax. Interest bill of $30,000, and we're making a loss of $10,500. In the past, we've been making a loss, no tax. New build, making a loss, no tax. But for this existing property, if it was purchased 27th of March 21 or after, we can't claim any interest. So yeah, we're looking at a taxable profit of $19,500. We can't claim that $30,000 of interest. So that's a big, big problem. And that's why a lot of property investors are annoyed, because you could be paying $3,000 or $4,000 of tax on that, but actually not making any money. So what National is proposing in their information is they're looking at 2024 staying the same, 50%. Year ending 31st of March 25, going up from 25 to 50%. 2026 going up from 0 to 75%. Year ending 31st of March 27, going from 0 to 100%. So then we could fully claim the deductions. When I talked about the properties that are currently on 0, that's where I'm sort of expecting, from the year ending 31st of March 24, I'm expecting still 0, not the 50%. Year ending 31st of March 25 to go up to the 50%. That is a guess, and we just need to wait and see what happens with that. Cool. So this change comes up. What am I looking at with my clients? What is the big opportunity that we're after with this? And so, if a 2-year Brightline comes in, obviously it's the time to fix mistakes. It's the time to get your structures right. If you've got an LTC with different shareholding to what you want, potentially we can use this 2-year Brightline to fix it, and still be aware, like if you're going to sell the property, don't restructure, because you're going to get caught by that 2-year Brightline. But there's potential there. If you're looking at holding long term, hopefully you're happy to hold for another 2 years. So we can look at that opportunity. Are you willing to hold it? If so, potentially we could restructure. If you've got one property in your personal name, one in your partnership, one in your trust, one in the LTC, maybe we can put all 4 together in one structure that's more tax effective. So now's the time to do it. Really worthwhile thinking, planning probably for the next 6 months. What could we do better? What can we do smarter? Can we do some sort of restructure? And 31st of March 24 is always the perfect time, either 31st of March 24 or the 1st of April. And it just means we line up with tax years. We're not having to do 2 sets of accounts in 1 year and cost you more in accounting. The other thing that higher interest rates and interest limitation is really highlighted is if you're a property investor on interest only, Your mortgage is still high. Interest limitation, higher interest rates really knocked your cash flow, and chances are you're struggling. Whereas if you've owned a property for 10 years and you've continuously paid down principal, your mortgage has got lower and lower and lower, and that has protected you. That's made you a lot safer. Your cash flow is going to be a lot better. The effective interest rate changes is a lot less. And the effect of the interest limitation is a whole lot less as well. So yeah, P&I perhaps been a little bit conservative, but it really does protect you long term. Restructure case study. So say you've got your personal home worth 800,000, debt 100,000, hopefully a normal sort of personal home, some big equity in there, 700,000, and now you want to turn that into a rental property. The problem is, if we keep it in the current entity where it is, we're only claiming 50% of interest if it's existing property. So if there's 100,000 mortgage, we're only claiming 50% of the interest on that. There's going to be a tiny interest deduction. It's not going to be really big at all. So then the smart sort of things that people start looking at is, can we restructure? So under the current rules, if we sell to a new entity, it could be a taxable sale. So be very careful that personal homes can be taxable. There's lots of ways that they can be taxed. So be careful on that, get advice. We're looking at a new Brightline, probably 10 years. That's a long time. Who wants to get tied up for 10 years? And current rules, we've got a sale 27th March 21 or after, so no interest deductions. Basically, it's no, no, no. It's a terrible idea. Generally, we don't want to restructure. The only ones we'd look at would be a new build, but we'd have to be very, very careful with the restructure. But basically, they don't work now. Then we look at rollover relief. Could we use rollover relief? In certain circumstances, we can sell to an LTC or a trust, and we can get rollover relief, so all those bad things don't happen. But the problem is, we've still got 100,000 debt. We've still got 50% interest deductible. Our interest deduction is tiny. We are going to make a big profit because we've hardly got any interest. So if the rules change, if National enact, get into government, they bring in these changes, they do a 2-year Brightline, they bring back interest deductibility, then we've got some opportunities. Maybe we could sell to a new entity. It borrows the full 800,000. All the interest is then 100% deductible if these rules come through. And you might find it's a first year 50%, second year 75%, but there's still going to be huge benefits in this. Potentially that example, we could be saving 14,000 in tax per year. That's not 14,000 interest, that's 14,000 in tax. It is huge. So if you've got a rental property, used to be your personal home, become huge opportunities to restructure and make that more tax effective. If you've got rental properties that have got huge equity and you've got large personal debt, maybe we can restructure. So what we need to look at is, if we're doing it solely for tax, we've got some big problems there. But if there's a legitimate commercial reason, and often there are legitimate reasons, we can look at these restructures. So if you're in one of those cases, personal homes become a rental, huge equity in your rentals, big debt in your personal, perhaps we can restructure. Or perhaps you've just got rentals in a whole lot of different structures, or your structure is not the best, you want to rearrange it. Worth having a property advisory meeting with me, planning out what's going to happen, planning towards a 31st of March or 1st of April date, and seeing whether we can structure. I'll add my Linktree link to the bottom. There's a free chat on that and a whole lot of great information on there as well. So you can book a free chat with me. Last little topic before we finish, 39% trust tax rate. So what's happened is that's draft legislation. It's not finalised. Currently, the tax rate is only 33% for trusts. If nothing happens, if a new government does nothing, it's going to stay at 33%. So that draft legislation has kind of gone in limbo. They actually need to reopen that legislation and get it going again for trust tax rate to change to 39%. So the draft legislation has trust tax rate changing from the 1st of April 24 to 39%. To me, a little bit in limbo. We don't really know what's going to happen. Most likely, we're probably looking at number 2. There seems to be an indication it's going to go to 39% for the trust tax rate. But with ACT probably being part of the government, who knows? So we can wait and see. The thing we do want to prepare for is if we're going to do dividends, we want to do them 31st of March 24 before. Why there's a 33% trust tax rate rather than a 39%. So say there's a profitable company. It's making $1 million. It's paid its 28% company tax, $280,000, and the shareholders want to get all the money out, which they should. They should get out of the company. It's the whole idea. So at the moment, we would do dividends through to the hopefully trust shareholder, tax at 33%. So they've paid 28%, 280,000. They would have to pay 5% dividend withholding tax, an extra 50,000 to give the shareholders, the trust, the full 33% tax paid dividends. If we wait until the 1st of April, it will then go to 39%. So we'd have to pay an extra $60,000. So it is huge when you're looking at a profitable company. So yeah, if you have companies, really important to look at how that's been done. This is for normal companies, not LTCs. So yeah, really worthwhile looking at dividends beforehand, and that's something that we're planning to do, yeah, probably in March to make sure we get the 33% and not the 39%. And generally for profitable dividends, there's two reasons to do dividends. One is the shareholders wants the cash out. That's good. If we don't do dividends, the company has to charge you interest, creates taxable profit for no reason. Yeah, we don't want overdrawn current accounts. We don't want you taking cash that you're not entitled to. It just creates more problems. And number two is asset protection. If you leave all the profits in the company and all the cash sitting there, then it gets sued. You lose all that money. Whereas if you've distributed the dividends, all the cash has gone out to the shareholder, you've protected that funds. It's very hard to then lose that if it's gone correctly out to shareholders. So dividends are a big important part. And yeah, planning for that possible 39% trust tax rate is really important. Like I said, Linktree, I'll chuck it in the links in the comments as well. But yeah, we have great videos in there. We have webinars coming up. Our next webinar is about trusts, whether you need it, and some tips. There's some great blogs. There's that interest limitation one I talked about. We've got past webinar recordings. If you want to have a free chat with me, you can book a time for me to ring, sometimes around a couple of minutes late. Unfortunately, that just seems to be me. But I will ring. We'll have a quick chat for 5 or 10 minutes. I can't give specific advice, but we can work out, is it worth having a meeting with me? What's the next step? Or can I put you on to a mortgage broker or a financial advisor? Yeah, someone else who can help you with what you're doing. So hopefully you've enjoyed that. Hopefully you've got some great information. And yeah, check out our Linktree. It's got some great things in there. Thanks a lot. Bye.